It was the darling of Wall Street, a company celebrated as the most innovative in America. At its peak, Enron was worth over $70 billion, and its executives were treated like rock stars. But behind the skyscrapers, polished smiles, and endless profits was a lie. A lie so massive, it would not only destroy Enron, it would wipe out the savings of thousands of families and forever change the way America looked at business. This is the rise and catastrophic fall of Enron, the greatest corporate crime in US history. The story begins in 1985. Enron was born from the merger of two small pipeline companies. At the helm stood Kenneth Lay, a charismatic businessman with powerful political connections. Lay dreamed of turning Enron into a global energy giant, but he wasn't alone. Soon, he brought in Jeff Skilling, a Harvard-trained strategist who believed energy could be traded like stocks, and Andrew Fastow, a financial wizard who knew how to bend the numbers. Throughout the 1990s, Enron rose like a rocket. It was no longer just about pipelines. It became about trading energy, broadband, even weather futures. To Wall Street, Enron was untouchable. Fortune magazine named it America's most innovative company 6 years in a row. Investors poured in money, and Enron's stock skyrocketed. But innovation wasn't the full story. Behind the shiny reports and endless profits was something far darker. Enron used a method called mark-to-market accounting, a trick that allowed them to record future profits as if they already existed. In reality, many of Enron's projects were losing money, but on paper, they were gold mines. To hide the losses, Enron created a maze of secret companies and partnerships, controlled by their CFO, Andrew Fastow. These shell companies took Enron's debts off the books, making the company appear far richer than it was. Investors saw a miracle. Employees believed in the dream. But behind closed doors, Enron's empire was built on sand. The house of cards was rising higher, and it was only a matter of time before it collapsed. By 2001, the cracks could no longer be hidden. Analysts began to ask questions. Whistleblowers inside Enron, like Sharon Watkins, warned that the company's finances were a ticking time bomb, but executives dismissed the concerns. Enron's stock, once worth over $90 a share, began to sink. Within months, it was worth less than $1. Employees lost everything: their jobs, their savings, their pensions. Families who had trusted Enron with their futures were left with nothing. And while ordinary workers suffered, Enron's top executives cashed out, walking away with millions. In December 2001, Enron filed for bankruptcy, the largest in American history at the time. The empire of lies had finally collapsed. The aftermath was brutal. Investigations revealed just how deep the fraud went. CEO Jeff Skilling was sentenced to 24 years in prison. CFO Andrew Fastow received 6 years after cooperating with investigators. Kenneth Lay, the founder, was convicted but died of a heart attack before sentencing. The Enron scandal shocked the world. It wasn't just about one company's greed. It was about how easily corporate power could manipulate markets, governments, and ordinary lives. In response, the US government introduced the Sarbanes-Oxley Act, a new law designed to protect investors and hold executives accountable. Enron's fall wasn't just a story of numbers on a balance sheet. It was a story of betrayal, greed, and the cost of unchecked ambition. Thousands of employees, investors, and families paid the ultimate price for a crime committed at the very top. But Enron was not alone. Because in the shadows of American business and politics, scandals have always been waiting, and some are even darker than Enron. Next time, we uncover one of the greatest mysteries in American history, the disappearance of Jimmy Hoffa.